Okay, let's unpack this. Welcome back to the deep dive. Today, we are strapping in for what promises to be one of the most intellectually stimulating and financially challenging deep dives we've ever done.
It's a big one.
We're focusing on the future of wealth creation, and we're being guided by the investment philosophy of one of the world's most, I'd say, aggressive and successful disruptor investors. Their firm oversees nearly $30 billion.
That's right. And our source material, it really provides a blueprint for investing in technological transformation. It's a philosophy they've honed over decades.
Right.
And while we absolutely need to understand that philosophy, we can't ignore the headline that has, captured everyone's attention.
I was just up to say.
It's a staggeringly bold prediction that one key investment is projected to grow by at least 5,000%.
5,000%. That doesn't just capture attention, that demands scrutiny. The projection, based on this research, it translates to a $1.5 million price target for that specific asset by, what, 2030?
By 2030, yes. That enormous number is the hook, absolutely. But if you walk away from this deep dive only remembering that price target, you've missed the point entirely.
You've missed the why.
You've missed the why. The real value here is in the mechanism, the economic and technological logic that drives that conviction. So our mission today is to extract that philosophy, identify the specific actionable insights, and understand the mindset required to ensure you, the listener, get on what the research calls the right side of change.
So it's about adaptation, really. Adaptation driven by deep research, not just, chasing some fast-moving stock ticker.
Exactly.
Okay, that sounds like a fundamental rewiring of how most people think about investing. So let's start at the bedrock. This whole strategy is built on 5 distinct, technologically enabled platforms that the research believes will just fundamentally transform the global economy. What are those 5 pillars?
Right. So the foundational philosophy is that the next wave of wealth creation is not going to be driven by isolated inventions, but by the convergence of these accelerating, technologically enabled platforms. And they had to meet some really strict criteria to even make the list.
Like what? What were the criteria?
Things like accelerating cost declines and cross-sector applicability. They are, and we'll discuss them in this order today. First, robotics.
Okay.
Then energy storage, which is just key to mobile robotics and mobility in general.
Right, batteries.
Third, artificial intelligence, or AI.
Okay.
Fourth is blockchain technology. They often call it the digital assets revolution. And fifth is multiomics sequencing, which is the new frontier in life sciences.
That list, right away it signals a break from traditional models. It's not about established sectors or value stocks.
Not at all.
The core belief here seems to be that these platforms, through their convergence, aren't just making small improvements. They are actual world-changing forces that will create enormous investment opportunities. But, and this is crucial, they'll also create huge job opportunities for those willing to adapt.
Exactly. And the inverse of that is just as important. The research suggests that clinging to seemingly safe investments, especially the ones that were dominant in the last market cycle, is actually a recipe for missing this transformation entirely. These platforms are deflationary forces that really punish inefficiency.
And when you look for a company that seems safe but is facing that disruption risk, the research points to one of the most beloved stocks in the world, Apple. How can a company with that kind of customer base and hundreds of billions in cash be a disruption risk?
It's a classic example of a dominant incumbent that, failed the AI test. The analysis asked a simple question a few years ago. What is the ultimate mobile device?
And the answer wasn't a phone?
The answer was the autonomous vehicle. It has a high operating margin, it requires deep consumer engagement, and it fundamentally changes commerce. It was a natural next market for a company like Apple.
And we all know about Project Titan, the Apple car. It famously failed and got shut down earlier this year.
Right, but the research noted a consistent pattern of management turnover on the AI front well before the project was officially killed. The conclusion was that Apple was not getting AI right. It was failing to make that necessary internal shift to a platform-centric AI approach.
So they'll be fine, but they won't be the driver of this next wave.
They'll be fine. They have that massive cash hoard, the loyal customer base. But its revenue growth is projected to slow to a crawl. It becomes what we call a mature cash cow.
So it's not a value judgment on the company's survival. It's a judgment on its potential as a vehicle for this kind of disruptive investment.
Precisely. The focus of this entire philosophy is on exponential growth derived from technological change. If a tech giant, even one of the Mag 6, is not prioritizing and mastering AI, or is failing to make its existing products AI-centric, then the disruption investors are just moving their capital to companies that are.
So Apple's story provides the contrast. Don't invest in companies that might be disrupted. Invest in the companies doing the disrupting.
That's the mantra.
That sets the stage perfectly. If AI is the main failure point for incumbents, let's dive right into the single biggest wave. We're moving to Section 1. AI, which the research identifies without hesitation as the biggest technological disruption in history.
And that's not hyperbole. They see AI as the general-purpose technology that unlocks the productivity needed across all the other platforms: robotics, multiomics, even digital assets.
And for a long time, the only way people felt they could invest in this space was through the picks and shovels supplier, NVIDIA.
Right, the GPU manufacturer. And that led to valuations reaching just stratospheric levels, suggesting a total addressable market that was almost unimaginable just a few years back.
That's the key insight, isn't it? The observation they made was that if NVIDIA's soaring valuation, which went well into the trillions, was correct, it served as this powerful signal that the total market for AI applications must be even larger.
Exactly. And that realization catalyzed the shift in focus towards the application layer, the true winners who deploy that computing power, stocks like Tesla and PLTR.
Okay, let's focus on the biggest of those plays, Tesla. The conviction here in the research is it's unparalleled. What's the central thesis that turns Tesla from just a car company into a dominant AI player?
The thesis is firm and singular. Tesla is the largest AI project on Earth, and you have to separate the car manufacturing business from the AI business. The core product is not the vehicle. It is the autonomous taxi network.
The Robo-taxi network.
That's the most massive, short-term AI application in ground mobility.
Okay, here's where the projections need some serious justification. Let's look at the financial predictions for this autonomous ecosystem.
The research forecasts that the entire ecosystem, the whole network, will generate somewhere between $8 to $10 trillion in annual revenue within the next 5 to 10 years.
8 to 10 trillion.
To truly grasp the scale of a $10 trillion market, consider this. The entire global GDP today is about $130 trillion. So you're looking at creating an industry that, in a decade, will be roughly the combined size of the economies of Germany and Japan. It is a tectonic shift of capital.
And that $2,600 per share stock prediction for Tesla in 5 years, how much of that is them actually selling more electric vehicles versus this autonomous network?
Almost all of it comes from the network. The current 5-year stock valuation prediction is at $2,600 a share, and a staggering 90% of that valuation is entirely derived from the projected cash flow of the Robo-taxi platform, not the underlying EV sales.
That is the critical distinction we need to make here. Okay, so let's make this practical. What does this Robo-taxi platform look like in operation for the car owner and, the person hailing a ride?
For the owner, it creates a new income stream. It turns a depreciating asset into a revenue generator. When you, the owner, are at work or asleep or on holiday, you tap a button on the app and your car just transforms into an autonomous taxi.
So it's out there earning money for you.
It's earning money for you. It chauffeurs approved passengers around via the Tesla app, either through a subscription or an a la carte model, and it becomes a fractional autonomous transportation provider. For the user, it's seamless. You open the app, hail a ride, and an autonomous car with no driver arrives at a fraction of the cost.
But this whole model hedges entirely on regulatory approval for full autonomy. You mentioned earlier in places like the UK and Europe, this is met with deep skepticism. What happens if the regulators just say no?
That is the single biggest risk factor, and the research is very clear that regulatory friction is the primary hurdle. Currently, regulators in many places haven't allowed full self-driving to operate commercially. However, the expectation of the researchers is that this will be overcome.
Why?
Due to both necessity and political momentum. In the U.S., the move from state-by-state regulation towards a federal standard is anticipated, which would accelerate the rollout and standardize the liability frameworks.
But liability is a huge factor. If an autonomous vehicle causes an accident, who's responsible? Is it the owner, the software provider, the manufacturer? How does the legal infrastructure handle that?
It does address it implicitly.
Yeah.
The fundamental shift is that when you remove the human driver, the liability shifts primarily to the operator, in this case, the software and the company backing the network.
I see.
The valuation assumes that the safety record of the autonomous network will rapidly outpace that of human drivers. When the data clearly shows these cars are statistically safer, regulators will be compelled to approve the commercial network, and only for public safety reasons.
even if it disrupts the current workforce.
And the disruption to the workforce is immense. Transportation is one of the largest employers globally.
So what's the cost reduction that drives this whole model?
The cost disruption is what unlocks that $10 trillion market. A current rideshare service, like an Uber or a Lyft, costs between $2 and $4 per mile in the U.S. That's largely to pay the human driver.
Right.
The prediction is that, at scale, Tesla will be able to offer that same autonomous service for just 25 cents per mile.
What?
You're cutting the cost of basic transportation by 90% or more.
25 cents a mile. That is a staggering, unprecedented deflationary force.
Yeah.
What does that do to car ownership, to insurance, to city planning?
It completely upends the traditional model.
Mm-hmm.
Personal car ownership becomes increasingly uneconomical. Why own a depreciating asset when you can subscribe to mobility on demand? It changes insurance models from focusing on driver behavior to fleet safety and software auditing. And here's where the convergence becomes essential. If you cut the price of something that dramatically, you get more of it. That means more miles traveled, which immediately leads to crippling congestion in cities.
So the very success of the Robo-taxi platform creates a new, massive problem that has to be solved.
Exactly. That paradox, that lowering the cost of ground transport leads to greater demand and thus worth gridlock, led the research to study mobility in the third dimension. That's the transition to eVTOLs.
Electric vehicle takeoff and landing systems, basically passenger drones or flying cars.
Right. And this isn't just theory. This next-gen mobility is already represented in the portfolio. Archer is a holding.
So the logic is, find the problem created by the first wave of disruption, the congestion from cheap robo-taxis, and then invest in the solution for the next wave, which is air mobility.
Leveraging the same battery and AI technology. It all connects.
That provides a perfect bridge into Section 2, which jumps from the robo-taxi to the, I guess, potentially even bigger story, humanoid robots and how they intersect with a looming demographic collapse.
And what's fascinating is that the aggressive $2,600 valuation for Tesla, it primarily covers the robo-taxi opportunity.
Yeah.
It doesn't assign much value to the humanoid robot business yet.
It's almost like a free option on an even bigger outcome.
It is. And yet Elon Musk himself has stated he believes the humanoid robot business will ultimately dwarf the robo-taxi business.
And the research agrees with that long-term potential, though it sees it as a slightly longer time horizon. The projected revenue forecast for the humanoid robot market is an astonishing $26 trillion.
$26 trillion.
It puts that $10 trillion ground mobility forecast into perspective, doesn't it? A market of that size is almost a third of today's global economy. Why does the research believe this market is so vast?
The answer is versatility. The robotaxi is a specialized robot for one task: driving. A humanoid robot, especially one with high dexterity, is a general-purpose labor unit.
It can do almost anything a human can.
It's exactly. Manufacturing, elder care, logistics, food service, construction, dangerous environments. And Tesla's positioned so well because the technology required is that same three-way convergence we talked about.
Right. It needs robotics.
The advanced actuators and physical components, it needs energy storage.
They have to be battery-operated and untethered.
And it needs artificial intelligence to interpret the world, plan movement, and learn from experience. Tesla is really the only company innovating across all three of those platforms simultaneously and collecting massive amounts of real-world training data.
We've all seen the videos of these robots dancing and doing synchronized movements, but the key is dexterity.
Absolutely. The research highlights that the goal isn't just walking and lifting, it's fine motor skills. Musk's stated long-term goal for these robots, the ultimate test of dexterity, is for them to be able to thread a needle.
Wow.
When a general-purpose robot can achieve that level of precision and is overlaid with accelerating AI, it just fundamentally redefines the concept of labor.
Which brings us to the unavoidable, almost existential question for the human workforce. If robots can do that, what happens to human jobs? Historically, technology has been a net job creator, but this feels different.
It's an important question. And you're right, technology has historically created more jobs than it has destroyed. But those new jobs were often in completely different sectors, requiring entirely new skills. When humanoid robots get awfully close to what we do, we have to define what remains inherently human.
And therefore irreplaceable.
The conclusion is clear. The continued human value will reside in creativity, judgment, and ingenuity. The ability to ask, what if we did things completely differently?
So we need to shift from routine, repeatable tasks, which machines are great at, to entirely new concepts of work. What does a job based on ingenuity actually look like in this new world?
We're already seeing new roles and concepts emerge, like something called vibe coding.
Vibe coding, can you explain that?
Sure, it's the practical application of AI in software development.
Yeah.
Imagine you need a complex, custom app for your small business. Traditionally, you'd hire an expensive developer fluent in Python or JavaScript, or buy a generic one-size-fits-all software package.
Right.
With vibe coding, you just use natural language programming, plain English, to instruct an AI tool, like ChatGPT or Codex Replit.
You just tell the AI what you want it to do.
Exactly. You tell the tool, I need an app that does X, Y, and Z, and I want the user interface to have a retro 1980s aesthetic with neon green alerts. The human's job is to define the creative vision, the functional requirements, and the aesthetic vibe. The AI does the coding.
So this leads to a massive explosion in customization and personalization, replacing that old, expensive, off-the-shelf software model.
Precisely.
And this convergence of robotics and AI, it couldn't be arriving at a more critical time, macroeconomically speaking. Let's connect the technological necessity of the humanoid robot to the accelerating global demographic crisis.
Right. The demographic profile is the essential macro justification that makes the $26 trillion robot market necessary, not just desirable.
We're seeing a population implosion in the developed world.
A fundamental one. Look at the data. In countries like Japan, China, much of the US and Europe, fertility rates are well below the replacement level of 2.1 children per woman. China's at about 1.2, Japan is around 1.3.
And that creates the inverted pyramid problem.
Exactly. You get a society that's becoming an inverted pyramid where the population of older retired people is expanding while the base of young working-age people is shrinking and aging.
Which creates a huge dependency ratio.
And a looming productivity crisis. Who will care for the elderly, build the infrastructure, and generate the taxes to support that society?
That's where the robot steps in.
AI and robotics become absolutely essential. They're not just competing with the current workforce. They are providing the necessary productivity to fill the gap left by a shrinking, aging labor force. They solve a profound societal and economic problem.
So if we connect this to the bigger picture, the research argues that the most profound, life-altering application of this AI convergence isn't in cars or even humanoid labor, it's in health and life sciences. Let's shift our focus to Section 3, Multiomics in healthcare.
Right. While AI and robotics dominate the near-term revenue potential, the research is clear that healthcare represents the most profound application of this technology, simply because of the human stakes involved. This is where AI is delivering life-saving breakthroughs today.
What are some of the current tangible impacts of AI in diagnostics?
Early diagnosis is already transforming outcomes. AI is enabling what's called a liquid biopsy, diagnosing cancer with a simple blood test, sometimes in stage 1 or even before clinical symptoms appear.
And the implications of that are just massive. Discovering a fast-moving cancer in stage 1 versus stage 3 drastically improves survival rates.
It turns one's terminal diagnoses into manageable conditions, and this capability is driven by a sophisticated three-way convergence of technologies under the umbrella of multiomics.
Okay, let's unpack the science here.
So multiomics refers to analyzing multiple biological omes, like the genome, the transcriptome, the proteome simultaneously. The key is how three technologies intersect. First, sequencing technologies.
That's the ability to read the biological programming code.
At ever-increasing speed and accuracy. Second, CRISPR gene editing.
The tool that lets scientists edit or modify that genetic code.
To fix the programming errors. And third, artificial intelligence. That's the component that processes and debugs the massive complex datasets generated by sequencing. AI finds the errors in the code and guides the CRISPR tool to the precise location for editing.
Reading the code, debugging the code, and editing the code, that's a powerful framework. But it still sounds a bit like science fiction. Can you give a specific real-world example of this convergence creating a cure today?
The primary example cited is CRISPR Therapeutics, which is a top holding in their specialty genomics fund. They developed the therapy, it's called Casgevy, to cure two devastating blood-related diseases, sickle cell disease and beta thalassemia.
With a single treatment?
Effectively, yes, with a single treatment. It is absolutely revolutionary for patients who previously had little hope beyond palliative care.
But let's bring in some critical friction here. You mentioned the current preconditioning for this treatment is gruesome. How do we justify that short-term medical burden?
That's a necessary point of friction. The current treatment requires preconditioning that is invasive, almost like chemotherapy. It essentially wipes out the patient's existing bone marrow before introducing the gene-edited cells.
That's intense.
It is. The research acknowledges this but stresses 2 points. First, the technology to make the preconditioning less intensive is advancing rapidly. Second, the demand is overwhelming because the diseases it cures are crippling.
Right. Patients with severe sickle cell might need 10 or 20 emergency room visits a year just for blood transfusions.
And pain management. So the short-term intensive burden of the cure is justified by the promise of permanent relief and a normal lifespan. It's the ultimate deflationary force in medicine. A one-time cure is far more economically sound than a lifetime of expensive chronic care.
Okay, let's pivot now to the fourth major platform and the headline grabber, the digital assets revolution, leading to that massive $1.5 million Bitcoin target.
This is the core engine of that 5,000% prediction. It traces its origin back to the summer of 2015 when Bitcoin was trading around $250. And it began not as a technological fad, but as a monetary thesis.
At a time when traditional finance was largely dismissing it as, a tool for illicit activity or just irrelevant.
Right. And the seriousness of the research was validated by its deep historical and economic analysis. A key figure, the economist Art Laffer, creator of the Laffer curve, advisor to presidents since Nixon. He read their initial white paper.
What did he say?
He declared that Bitcoin was, and I'm quoting, "what I've been waiting for since the U.S. closed the gold window in 1971, a rules-based global monetary system like Bretton Woods."
Wow. That comparison immediately lifts Bitcoin out of the realm of just software and puts it directly into the context of global monetary policy.
It does. Laffer was arguing that for nearly 50 years, the global economy lacked a truly rules-based system, one that couldn't be manipulated by a single government's fiscal or monetary policy.
And the thesis expanded quickly beyond just a monetary system to establishing Bitcoin as a new asset class entirely.
That's the argument for institutional adoption. BTC is argued to be the first truly new asset class since equities emerged in the 1600s. We traditionally define asset classes as, stocks, bonds, commodities, real estate. Bitcoin is unique because it provides true diversification.
Its performance metrics are fundamentally different from traditional assets.
Especially during periods of geopolitical stress or extreme money printing.
Mhm.
And that matters to institutions because they compete on performance. If an asset class exists that offers uncorrelated returns, institutions managing trillions are compelled to consider it.
Okay, let's get to the mechanics that drive the 2030 forecast of 1.5 million per Bitcoin. What are the three biggest drivers for a 5,000% gain from here?
The forecast relies on 3 converging forces that introduce massive demand into a very inelastic supply market. First, institutional investment.
This is the most immediate catalyst.
It is. After the spot Bitcoin ETF approval in January 2024, institutions, pension funds, wealth managers, endowments, they're just starting to commit capital. They move slowly, but when they move, the impact is immense.
So how does institutional portfolio allocation actually create the demand needed for that price target?
The research suggests that if global institutional wealth managers shift just 1% of their assets into Bitcoin, a conservative allocation, that demand completely overwhelms the supply. And crucially, there will only ever be 21 million Bitcoin. Only about 1 million remain to be mined today.
So we're already in a permanent supply shock environment.
We are. The second driver is store of value or digital gold. There's a profound generational shift happening. Younger generations are just significantly more comfortable holding digital assets than physical gold bullion.
Right, which has high storage and transaction costs.
Exactly. As wealth transfers across generations, vast amounts of capital currently in physical gold will likely transition into Bitcoin.
Okay, and the third driver.
This one is often overlooked, but it's critically important. Emerging markets insurance. BTC and stablecoins offer an insurance policy against policymakers who lack fiscal or monetary discipline. If you live in a country like Venezuela, Argentina, or Turkey, where your local currency is suffering from hyperinflation,
Bitcoin provides a non-sovereign, hard-capped asset. It's an essential tool for basic survival in those economies.
Exactly. And the stablecoin part. These are digital tokens backed one-to-one by U.S. Treasuries. That offers access to U.S. dollar stability without needing a U.S. bank account, which is revolutionary for global commerce in these high-risk markets.
Okay, so let's move beyond Bitcoin itself to the infrastructure supporting the system, the broader digital assets revolution.
Right. The research reframes this as the financial internet.
Yeah.
And the investment thesis in Coinbase is crucial here because it is seen as the safest, most regulatory compliant exchange in the world.
And they've been fighting that battle with regulators like the SEC.
A costly and difficult fight, yes.
Hmm.
But they're helping educate policymakers that this is just the financial infrastructure that developers failed to build into the internet back in the 90s. And Coinbase is actively evolving.
Right. It's more than a simple spot exchange.
Absolutely. It's gone global, acquiring Deribit, which is a major options exchange, and establishing a futures exchange. This positions them deep in the derivatives market, which is where the largest institutional capital resides. They're building the new payments infrastructure and acting as the compliant on-ramp for those huge institutional flows we just discussed.
And the focus remains tight on just a few assets.
Yes, the primary focus is on the big three: Bitcoin, the most secure blockchain, Ether, and Solana, while acknowledging that the vast majority of the millions of other digital assets will inevitably fail.
We've covered the platforms and the extraordinary price targets. Let's shift in Section 5 to the actual investment strategy, the mechanics of disruption, and the quantitative tools used to drive these picks. What non-traditional criteria determine which companies get the capital?
The most important characteristic defining an innovation platform, and therefore a valid investment, is adherence to Wright's law. It is a non-negotiable quantitative criterion.
Okay, that sounds dense. We need to go deep here. How does Wright's law work, and why is it better than, say, the more famous Moore's law for predicting disruption?
Moore's law is time-based transistors on a chip doubling every 2 years. Wright's law, however, is experience-based. It measures the learning curve. It predicts how fast costs will decline over time as cumulative production, or more accurately, cumulative experience increases.
It's a measure of efficiency gains. Can you give us a concrete example?
Take the costs of solar energy or batteries. The analysis might show that every time cumulative production of solar panels doubles, the cost per watt drops by, say, 28%. Wright's law lets the firm create a quantitative model for where those costs will be in 5 or 10 years.
So it predicts the deflationary power of a technology.
Exactly. Since technology is inherently deflationary, these falling costs are passed through as lower prices or better performance, letting the technology spread across the economy much faster than consensus estimates predict. If a technology doesn't show evidence of adhering to Wright's law, it's deemed too slow to cause the necessary disruption.
And what are the other criteria for a platform to qualify?
It has to cut across multiple economic sectors.
Yeah.
It can't be niche. And second, it has to serve as a launching pad for new technologies. Think of it like a chain reaction. DNA sequencing was needed as the foundational technology before CRISPR gene editing could be developed.
I see. Sequencing showed the errors. CRISPR provided the fix. Okay, let's put this powerful deflationary force into the context of global economic growth. The research makes an absolutely astounding claim about future GDP growth.
It does, and it needs historical context. Between 1500 and 1900, before electricity and the internal combustion engine, real GDP growth was sluggish, about 0.6% a year.
Then, after the Industrial Revolution, it accelerated to about 3% a year for the last 125 years.
Right, that 3% was the modern benchmark. Now, if the convergence of these 5 innovation platforms, AI, robotics, energy storage, multiomics, and digital assets, is modeled correctly using Wright's law, the projection is that real GDP growth in the next 5 years could accelerate to a rate of 7.3%.
7.3%. That's more than double the post-industrial revolution rate. What platform provides the biggest boost there?
AI and robotics, largely through the productivity gains we discussed. AI doesn't just make existing workers more efficient. It automates entire segments of labor, solving the demographic crisis while simultaneously increasing output.
Which creates enormous investment and job opportunities. This suggests the technologies focused on could go up more than tenfold, 1,000% return in the next 5 to 10 years. For the individual listener who's intrigued but doesn't have time to model Wright's law for every stock, what is the core, actionable investment advice?
The philosophy is focused on aggressive growth, and the technique is simple: averaging in over time.
So a long-term strategy, not trading.
Exactly. It means committing a small amount of capital, say a portion of every monthly paycheck, to this theme. You buy exposure to the future, regardless of short-term volatility, because the cost curve and growth trajectory are seen as inevitable over a 10-year horizon.
And the simplest tool recommended for broad exposure.
Using an ETF, an exchange-traded fund. It provides immediate diversified exposure to 35 or so high-conviction stocks across all the innovation platforms. It simplifies the process for the individual investor.
Right, let's give the listener the definitive list. What are the top 10 public stock picks that currently represent this highest conviction view of the future?
Okay, these are the high-conviction positions representing the firm's belief in the future of the 5 platforms. First, Tesla.
The largest AI project.
Then Coinbase, the compliant financial internet. Robinhood, innovating and democratizing finance. ROKU, the dominant operating system for connected TVs. CRISPR Therapeutics for gene editing. PLTR for AI software. Archer for air mobility. Shopify for e-commerce with AI. Roblox for user-generated social platforms. And finally, TSM, Taiwan Semiconductor Manufacturing.
Let's quickly focus on a few of the less obvious ones like Roku and Roblox. How do they fit the definition of a deep disruptive platform?
Roku is fascinating because it's the operating system for connected TV. It's a pure platform play, controlling the data and user experience for the largest screen in the house. As AI advances, personalized, targeted advertising based on real-time viewer engagement becomes incredibly valuable.
And Roblox.
Roblox is a critical early indicator of the future of work. 60% of its user base is now over 13. Kids are learning not just to play, but to create virtual worlds, storefronts, experiences. They're learning business mechanics, digital asset monetization, and even early concepts of vibe coding.
It's a generative content engine that's training future AI collaborators.
Exactly. And TSM, of course, brings in the unavoidable layer of geopolitical risk, given its concentration in Taiwan.
Right. Every major chip company, NVIDIA, Apple, relies on TSM's fabrication plants.
It's the most critical link in the global supply chain. Its concentration in Taiwan is the primary security risk highlighted in the research, which is why TSM is actively diversifying production into the US and Europe. It is the definition of a foundational platform that must be resilient.
Okay, let's pivot to the human element behind several of these top picks, specifically Elon Musk. He is central to Tesla and other ventures. His recent political involvement has been noted to cause measurable impacts, like the Q1 revenue decline at Tesla. How does the research handle that volatility?
He is consistently viewed by the research team as the Thomas Edison of our age, a troubleshooter-in-chief who focuses on solving the hardest, most fundamental problems facing humanity: sustainability with the Tesla, space travel with SpaceX, and labor with humanoid robots.
But the volatility he introduces, his political alignment, that's not standard CEO behavior.
The Q1 revenue decline was acknowledged to be a combination of macro factors overlaid with a political dynamic that impacted public sentiment. The analysis, however, interpreted the core sentiment behind his political involvement as addressing critical economic issues.
Like government spending, indebtedness, inflation.
Things that disproportionately hurt the poor. So the research separates the goal from the execution. Let's look at the tariff strategy under the prior administration. It was chaotic, but the research still supports it at a high level.
How so?
That's where strict neutrality is essential. The research concluded that while the execution caused significant short-term chaos, the underlying objective was noble: to reduce both U.S. tariffs and global non-tariff trade barriers.
So an attempt to bust up long-standing trade restrictions like Canada's 250% tariff on U.S. milk?
Right, or restrictions on U.S. beef and ethanol. The conclusion wasn't that the policy was perfect, but that the individual running it felt he had to sound crazy for global partners to take the threat seriously and come to the negotiating table.
Okay, moving into our final section, Section 6. Let's step back from the specific investments to focus on critical thinking, risk, and the unanswered questions. Given the extreme optimism for a 7.3% GDP growth rate, what is the single primary concern of the research team?
Despite the unprecedented opportunities, the primary concern is not technological failure or regulatory delay. It's that people will be caught out by these new technologies because they are unwilling to adapt.
Unwilling to adapt in disrupted industries, transportation, retail, healthcare.
Exactly. Retail, for instance, is set to be disrupted by personal shopping assistants driven by AI that anticipate what we want and find the best price globally. The concern about potential inequality isn't about blaming technology, it's about the requirement for initiative.
Initiative, the willingness to step forward and learn the why behind this transformation.
Those who start reading up, learning, and using their imagination to find connections will find immense opportunities. That's why the firm makes its research and its big ideas, white papers, open source, to educate people so they have control over their adaptation.
Which brings us back to the core dilemma of work. If AI excels at pattern recognition, how does the destruction rate of old routine jobs meet the creation rate of new, inherently human jobs?
The key is distinguishing what machines do well versus what humans do well. AI excels at pattern recognition, which is based on history, what has already happened. Humans must focus on the disruptive elements, the white sheet of paper research, the creativity, the ingenuity, the things that break patterns.
We have to evolve how we approach performance, like the story of the game of Go.
It's the perfect analogy. When Google's AlphaGo first beat the world Go champion, Lee Sedol, he was crestfallen. But his response was not to quit. He then started playing against the machines, using them as training partners.
And he dramatically improved his human game.
Discovered entirely new moves and strategies that humans had never conceived of. Machines will elevate human performance. They won't simply replace it. They just set a new, higher bar. The greatest opportunities will go to those who aren't held back by preconceived notions and are willing to take risks on themselves.
This has been a monumental deep dive. We've covered potential tenfold investment returns, a projected 7.3% acceleration in real GDP growth, and the wholesale transformation of mobility and healthcare. It's about more than just money. It's about future preparedness.
It is about empowerment. The core message is that you have control over adapting to this change. Don't wait for permission. Use the resources available, like the open-source Big Ideas white papers, to learn the why behind the shifts we discussed today.
We always like to leave you with one final provocative thought that builds on the material.
Let's revisit the revolutionary idea that only a few years ago sounded crazy but turned out to be completely right. Autonomous vehicles are fundamentally robots. It seems obvious in hindsight, but it wasn't when the research began.
So we pose this question to you, the learner, to consider as you go about your day.
What revolutionary idea, based on the convergence of these existing technologies, AI, robotics, energy storage, sounds absolutely crazy today, but will be completely obvious tomorrow? The research encourages radical imagination. Think about things like transformer robots that have legs but can fold up like a tank, or boring tunnels on Mars. We encourage you to embrace imagination, look for the connections, and think beyond the obvious to find the next great convergence.